Hi guys, another monthly roundup for you here from FX Scouts. My name is Chris Kahak, and we're going to be looking back at the last months on the markets in November. No surprises, it's been dominated by the so-called Trump trade. So we're going to look at a few asset classes that have been specifically affected by Trump's election victory, and look at a couple other things as well. We're looking at the Fed rate decision, and we'll look ahead to the next Fed rate decision in December, and then we'll look a little bit further beyond that as well, into the new year and what actually happens when Trump assumes the presidency of the United States. But first off, let's have a look at the few asset classes that have been quite heavily affected by Trump's election victory. First off, we'll look at the S&P 500. You can see that the stock market has done very well in the United States off the back of Trump. This is because Trump's policies are seen as being very business friendly, especially in terms of deregulation. So the S&P 500 has done well as a result of this, and will probably continue to do well in the near future. The dollar is one of the big stories here. The US dollar, as represented by the DXY, which is the dollar index against a basket of other currencies, has been incredibly strong throughout November and will probably continue to be so. Trump's policies are seen as very inflationary. This is mainly due to a lot of his talk about tariffs, which we've seen and we will come back to a little bit later in the video. And as a result of the inflationary policies that he's putting in place, we expect interest rates in the United States to remain elevated throughout at least the start of his term, if he follows through on a lot of his intentions. As a result, the dollar will remain strong. We've seen a little bit of weakness in the last few days, but I don't expect that to continue. As I said, we're going to come back to DXY. I want to look at a few more things in more detail. Bitcoin, the big story. I'm sure everybody is aware who is watching this. Bitcoin has been through the roof. Crypto in general has seen huge returns over the last month. Nothing quite on the same scale as Bitcoin. It keeps retesting the 100K barrier against the US dollar. Will it break through it? Yes, it will break through that. When will that happen? Could be in the next few days, could be in the next few weeks, could be in the new year, but it will happen. And once it does, all bets are off for how high it can go. This is mainly due to Trump's policies, especially in light of deregulation for the crypto industry. Seen as very beneficial for cryptocurrencies. The only way I can see a downside to crypto is if Trump doesn't follow through on his promises to deregulate the crypto industry. Then we could see a really hardcore reversal. But I don't expect that to happen. I expect crypto to be 2025 is going to be a very good year for crypto. The other asset classes that have been affected by the Trump trade include gold, which, as we all know, has been on a really strong bull run throughout most of 2024 and hit the buffers when Trump won the election. Gold is priced in US dollars with a strong dollar. It's not looking like such a good deal after all. Also, as a haven asset, it's losing its luster a little bit, especially in light of other assets performing so well, like, as I said, cryptocurrency and the US dollar against most other currencies, stock markets. There's a lot of other places for gold bugs to put their money into right now. Gold, I think, will struggle to recover to its previous highs, especially with the US dollar strength continuing, I think, as a result of Trump's inflationary policies. So yeah, gold will continue to struggle. I mean, you have to be aware here with gold as well. It's a haven asset class, with Israel and Hezbollah signing their peace agreement. Well, their temporary ceasefire at the moment. The war in the Middle East is looking like it might cool that down to a simmer rather than a boil. Trump has also made it very clear that he wants the war in Ukraine to end as soon as possible. So we could see gold, as I said, continue to struggle. But yeah, let's come back to the DXY. And in particular, I want to talk this month about the return of Trump and the social media outbursts dictating policy and affecting markets. So twice in recent weeks, we have seen Trump make statements on social media, either on Truth Social or on X, formerly Twitter. The first was a threat to impose a 25% tariff on all goods from Canada and Mexico into the United States. And what's really interesting, if you look at the DXY, a few days prior to this outburst, he had nominated Scott Bessent as Treasury Secretary. Yeah, Scott Bessent is seen as someone who might stay Trump's hands when it comes to his more incendiary ideas regarding tariffs. And as a result, we saw the dollar fall a bit after Scott Bessent was nominated. Literally within 24 hours in market terms, Scott Bessent was nominated on the Friday, and then on Monday, Trump took to Truth Social to write about the tariffs he wants to impose on Canada and Mexico. And we saw the dollar immediately resume its climb. It actually gapped quite high as a result of this, because, any tariffs on Canada and Mexico would be hugely inflationary for the United States. And as a result, the US dollar would strengthen considerably. And then again, we saw just a few days ago now, Trump again on social media, this time on X, I think, rather than Truth Social, stating that he was threatening the BRICS nations, that if they tried to form a separate global reserve currency, he would slap 100% tariffs on all their goods, and all members of the BRICS nations. And we saw the markets move accordingly. Again, we saw the dollar strengthen. And what this highlights, and something that I think all traders got to be aware of now going forward, is that we're going to see the markets hugely buffeted by Trump's social media outbursts going forward. And this is much like it was in his first term as president. So there's something very much we've got to be aware of, that the currency markets are particularly sensitive to these kind of messages, this kind of messaging. And we're in for a very much more period of a much higher volatility, I think, over the next few years, especially when it comes to tariffs. And this is something I did want to talk about specifically in more detail. And I wanted to highlight an article, an op-ed that was written in the FT a few days ago. And it's titled "Big Changes Are Coming for Dollar and Emerging Markets." And this article specifically highlights the threat of tariffs that Trump wants to impose. He's talked, especially specifically on China. He's mentioned a 60% tariff on Chinese goods coming into the United States. And what this article refers back to is the last time Trump was in power, when he imposed a 25% tariff on Chinese goods coming into the United States. This tariff was kept in place by Biden and still is there today. Trump has also, and members of his team has also pointed out that there wasn't much inflation as a result of the tariffs that he imposed on China the first time around. And this is true. And the main reason didn't really see an inflationary pressure is because the yuan, the Chinese currency, was allowed by the Chinese government to depreciate to a scale of about 10% shortly after the tariffs are imposed. And this effectively nullified the effect of the tariffs, as it meant that Chinese goods could remain competitive in the United States. The issue with this going forward, if we look to January when Trump does take the reins of power in the United States, is if he imposed a 50 to 60% tariff, what scale of depreciation would the yuan need in order for China to remain competitive in the United States? It would have to be a lot larger of a depreciation. Could China tolerate this? Yes, they could. Will they do it? Probably. 60% is obviously a lot larger than 25%. But in order to remain competitive in the United States, Chinese would feel they have to do it. The problem with this is not just the effect on the Chinese economy having a scale of this depreciation. There'll be a knock-on effect across the regional currencies in Asia. And from there out, it would, like a ripple effect, would see a huge depreciation across most emerging market currencies as well. And as the author writes, there would be a threat of explosive devaluation of currencies that are pegged to the US dollar, whether it's a hard peg or a soft peg, like the Turkish lira and Argentina, etc. Any currency that tries to peg to the US dollar that in emerging markets heavily reliant on China would find itself in a very difficult position. So there is potential for extreme chaos in emerging market currencies in the new year if Trump does follow through on these tariffs. We also have to think about the Federal Reserve as well. The Federal Reserve have got a meeting coming up on December the 18th, where they're going to decide on whether to cut rates. And they'll be thinking very carefully about this. They're not going to come out and publicly say that they're going to be looking ahead to the threat of Trump's tariffs, but it is definitely going to be weighing on their mind. Right now, they're looking at jobs data. We just had the JOLTS report just came out this afternoon, and it was much of nothing. But this Friday, the 6th, we've got the NFP, the non-farm payrolls coming through. And this is really the last big bit of jobs data that the Federal Reserve will get to look at before they make their decision on the 18th of December. And they're going to be keeping a very close eye on that. If we see that the jobs market comes in still very strong, then it gives the Fed a really good reason to hold rates steady. Currently, the CME, Fed Watch futures traders have the probabilities at about 30% that the Federal Reserve will keep rates on hold versus 70% that they'll lower them. Expect this to fluctuate over the next few days. Expect that to go wildly in favor of holding rates steady if the NFP comes through very hot and if jobs data continues to support that, especially in light of Trump's potentially inflationary policies in the new year. So there you have it. Volatile markets. I think December is usually a quiet month. I think this December will be less quiet. I expect it to be quite volatile over the next few days, the next couple of weeks in the run up to Christmas, especially if Trump sticks to social media. Keep an eye on those job openings and the NFP, the payrolls coming out this Friday. And I think in the new year, we can expect to see huge continued volatility in the currency markets. And especially if those tariffs do come into force, if Trump does start playing the tariff card, if he follows through on his threats, then we could see serious instability, economic instability, and huge volatility across not just, obviously we'll see it in the major pairs, but the emerging markets. So you're talking minor pairs, you're talking exotics. There could be huge volatility across those. I hope you enjoyed this. Enjoy maybe too strong a word. I hope you found this useful. If you have any questions, get in touch with us at podcast@fxscouts.com. I'll be back early next month with the roundup of December. Thank you so much.